Okay, so Flo, circling back to the issue on capital, could we have further discussion on the different stages of capital? That is now the Series A, Series B, depending on the stage of growth, whether it's early stage or for growth stage startups.
Okay.
And what is key or what is needed or what should founders show at these different stages of raising capital?
Sure. So today I wake up, I go to take a matatu and I realize how hectic it is. And I'm like, you know what? I don't want to deal with this anymore. I want to start a company that helps you. You can see where the Ubers are and people can maybe go to different places instead of being crowded. So I have this idea. Let me test it. Right. So you build an app, you iterate it with some few customers. Like, okay, this is great. There's huge interest. People are starting to pay for the app. But you realize that you need to scale because one, there's a huge demand. People are asking for this product a lot, right? But you don't have the resources. You are growing faster than you can actually. You need more team, more marketing or more customer support, all of that, right? Okay, fine. So now you go, that's your pre-seed, right? Because now you have an idea that is somehow proven, right? With a few customers. So you go raise your pre-seed to talk to a few investors. And they give you maybe like 600K. Like, okay, you have proven, as I said, it's de-risking each stage. So you have already de-risked that the idea is already there and it's already working. So now let me go and try it on a higher scale. Like, okay, fine. I was maybe doing it just in my neighborhood. Let me now do it in Kilimani and Westlands. Okay. So you tried that for your after raising your pre-seed. Like, okay, this is actually working. This is a really good opportunity and it's working. You iterate, you twist a few things. Okay, you go back to the same investors. You're like, okay, I need more money. It has worked in Kilimani and Westland. I want to do it the whole of Nairobi. Perfect. So they give, now you raise your seed round, which will be, I don't know, a 1.5 million round. Two other shoe investors, right? And then you go try it in Nairobi. Maybe it starts running into trouble. And you realize this thing was only working in Westland and Kilimani because people have money. And you're charging maybe too much, right? And before you actually capture the market, you realize money is already over. So what happens in that most of the time is you might need to raise like a in-between stages round. Right? So maybe you raise like a seed extension. Some people call it a seed extension or a pre-series A. Like, we are getting to series A, but you want to get before that.
A pre-series.
Yeah, pre-series A, just to make things better.
So how many millions?
It depends on how much you need. But what I usually advise founders is every time you have 12 to 18 months cash, so you have a burn rate. Every single month, this is how much I'm burning. And you realize you only have 12 to 18 months before you're tapped down the early stage. Go raise.
Okay.
Go raise immediately.
And at this point, is this business profitable?
No.
Oh, good.
Profit is just a fancy word.
Okay.
That I've never thought about at this stage. It's more like, hopefully one day we'll be profitable. But that's not really close, right? Because you're building as much as you can to capture the market so that no one else can actually capture before you. So that's okay. Like, okay, fine, let me go raise. So you iterate and realize you need to reduce your prices. So you reduce your prices to go to other places. Right? So let's say, okay, I want to go to, like Madaraka. Like, okay, people in Madaraka are willing to pay, but pay lower. So you reduce the prices and now you buy yourself some more time with the pre-series A. Fine. So that works. So now you get to series A. If you are in more developed markets, you can raise a series A without being profitable.
Okay.
Right? Maybe with like a $2-3 million in revenues. You can raise like a series A quite comfortably and investors will help.
That is still around the same amount, $2-3 million?
Series A it's usually like a bigger step.
Okay.
Because now just Nairobi, now you're doing maybe the whole of Kenya.
Okay.
Right? So now it's a huge step and you really want to see how this goes, right? So yeah, in other developed countries, you can maybe raise a pre-series A without a path to profitability. But in African markets, especially since funding has decreased.
Yeah.
People are asking you a lot of questions around, are
You
you
need to prove.
profitable? Yeah, is this going to be sustainable in the long term?
Yeah.
Right. So now you raise a bigger round. So it's not the 1 million, 2 million, maybe more than 5 million.
Okay.
Right. And now you decide to do it in the whole of Kenya. You do it for a few months, 12 to 18 months again. And this works. You want to expand to Uganda, Rwanda and the other countries in the neighborhood, in the region. So you raise maybe a Series B to do that, right? And after that, it's just continuing raising and expanding the space, right?
Okay.
You can also decide to add more products. Like, okay, people are traveling a lot with this app. Maybe I can add some insurance product. If you want to take insurance while you travel, right? A very good company called Motisure that is actually working on that.
Yeah.
Or you want to add, I don't know, some form of financing. I can help you buy a ticket and you pay me later.
Okay, yeah.
Right? So there is different things you can add. And if you realize that you need to scale quite significantly, maybe go into a new market or start a new product, whereas now the next stage you can be a Series B, Series C, depending on where you are.
All right. Can we have a discussion on the Series A crunch in Africa?
Okay.
Where, as you said, investors at this point have to prove at least a little bit amount of profitability for founders, or not for founders but for investors to believe that this business is solid. There's traction and there's opportunity for growth and for scaling. So why is there this Series A crunch? Why are founders having a hard time raising capital at this stage?
Yeah, it's not just founders who are having a hard time raising. Funds also are having a hard time raising.
Okay.
So we haven't had many success stories. Well, we have good stories. We have the Flutter Wave, Paystack, but these are not like huge exits that can encourage a lot of huge players to come on the continent. And I think that's something we need to work on.
Okay.
And because of that, we don't have really big funds to cover like the Series A. Right? A lot of funds are in the less sub 50 million type of funds, right? And if you think about that, those funds are not most of the time the right partners to do. They can do, but they need someone else who's a bigger player, right? Like you have, like in Africa, you have Patek, you have TLCom, you have the likes of Lightrock, who have more than 200 million under management, but those funds there are not many of them.
Okay,
there are very few.
Okay,
and because of that, it just becomes hard as you grow as a company to get access to more money because there's no bigger funds who can actually support you, right? And because they're also very few, they start also being very selective about the type of companies they have. So it's really a question that we haven't had good success stories, right? And that hasn't encouraged huge amounts of capital to come at the growth stage. And you, as a company, as we have already seen, you earn a lot of money.
Yeah, you really need to.
Yeah, and we haven't had now that kind of like growth stage capital to come on the continent. Hopefully soon, but not yet there.
Yeah, I think the solution to that, as we've seen, is co-investing, where different funds come in at this stage.
True.
And
co-investing is really important, and also you need to start building relationship with outside investors. If we don't have investment funds that can cover that, you can have maybe like an international fund. I've seen a lot of MENA fund, come here and try to bridge that gap. That's one. Local funds, local investors can also play a key role. But as you know, local investors are very risk averse. They rather see their money in a bank or in a bond or in real estate or in land.
Oh yeah,
than invest in tech that is the cloud. Right.
Yeah.
So I think there is need to attract higher capital. Now, co-investment is one way to do it. But you really need to raise bigger funds.
Okay.
Definitely. Yeah.
Okay. So previously we would see more VCs or focus on equity, but there has been a rise in venture debt. And I think last year there were like 64 deals on venture debt, which is new and a new concept.
Yeah.
So why is that? Why debt? Why the sudden or some slow shift from equity into debt?
Yeah, debt is it can be straightforward.
Okay.
Or more straightforward than equity, right? If I'm a debt investor, I'm coming to you. You don't sell me a vision.
Yeah.
How are you going to pay me? That's what I'm asking you. I'm not asking you, in 10 years, in 20 years, where do you think I'm going to be? No. I'm giving you 1 million today. I expect you to pay 100K every quarter for the next X number of quarters.
Okay.
Right? It's very straightforward. So I look at your numbers. Do you have the ability to do so? Do you have the contracts to do so? Right? And if you do so, if you have all of that, then it's easy for me to provide that kind of capital.
Okay.
So as it becomes hard to raise equity, so founders need to start thinking about what other sources are there, right?
Yeah.
Which is good to see because it can also take you from where you are to the next stage.
That's true.
And that is very much needed. That comes when the investment is pretty much de-risked initially. So you really you need that. But it's not a substitute to equity. Both are needed. But it can play a critical role, especially when equity is not there.
Okay. So looking at Africa and VC's perspective, yeah? If you're in East Africa, South Africa, or in West Africa, I mean, it has been said that when the rest of Africa is pitching stories, Nigerians pitch war stories on survival and then growth later. So is it, what is different depending on which side of the continent you're in?
Yeah, it's a really good question. I have interacted with a lot of West African founders, especially Nigerian founders. The market over there is massive.
Yeah.
Right. Kenya is 50 million people. Nigeria is just insane.
Yeah.
Bigger economy.
Yeah.
And it's not just a bigger economy. There's also density around like key towns. If you think about like Lagos, it's highly dense, which even attracts more opportunities. Right? So that itself, remember again, we think about the huge returns that you need to get. If you have a market like that in Nigeria, that very much encourages you to think about that. That's one. The second thing is Nigeria didn't have many solutions actually, right?
Okay.
M-Pesa has been here for the last 18 years. That has, even the solutions that are built after that, they are kind of limited.
Yeah, and they're somehow leaning on M-Pesa.
Exactly. They're also leaning on M-Pesa. Sometimes M-Pesa can make your life interesting when you're building on top of it, right? But Nigeria didn't have that, right?
Okay.
That's why you see companies like Moneypoint, Flutterwave, right? Building there because it was very rudimentary and they're really solving a critical issue that wasn't there before. Right? They also have a huge community of Nigerians outside. Diaspora plays a key role. So remittances, as you know, are very important for the continent.
Yeah.
Which also opens up another opportunity, right? So the market is big. That you cannot deny. So that's point number one. There's a point that I don't know how to explain it, but it has to be said. When you have that kind of ecosystem where you have a huge market, competition becomes hard and startups, really fight against each other.
Yeah.
Right. That encourages even more dynamism in the ecosystem.
Okay.
Which brings, a lot of quality founders, right?
Okay.
That friction, nothing great. Diamonds are made.
So that is what is making Nigerians better at this?
I will say yes. I think those are two areas that I think are very interesting because you have a huge concentration of startups. That helps. And then lastly, we have to talk about it again. Kenya is a good country. I know Kenyans are not always happy with their leaders and they should not be. Yeah. But Kenya has actually established infrastructure that is better than other places.
Okay.
Right. And what that has done, we have a lot of international organizations that are here. We have a lot of, donor funding that is here, grant financing that is here. So a lot of companies in Kenya have really, traditionally, depended on, grant money, free money.
Yeah.
And that does not encourage sustainability in the long run. Right. Which is a really sad thing to see. So I think more numbers driven, more commercial driven type of opportunities need to be seen, not just in Kenya, but in East Africa in general, right?
Yeah.
Compared to West Africa. Like Kenya has raised more grant financing compared to anywhere else in the on the continent.
Okay. Yeah,
Right.
that's really good to hear.
Yeah, but it also discourages because when you get a lot of grant financing, there's no push for commercial financing. Right. So I think we need to see more commercial driven initiatives.
Yeah.
But I'm sure in the long run, Kenya will have more opportunities. I think the ecosystem is more encouraging here compared to anywhere else in the continent. Well, except South Africa, which is on its own space. But yeah.
Okay.
So that's East and West, yeah.
Okay. And when looking at different founders or looking at different startups, maybe in their pitch decks, in the stories that they are giving, what would you say as an investor comes out as a red flag or something that would be an immediate no from the onset, or maybe at a certain stage of the growth of the startup?
Well, the more you grow as a startup, right, the more numbers play a key role. In the early days, the vision, can help you. The vision storytelling can help you raise money. But as you grow, the numbers become quite important, right?
Yeah.
So if I don't, and that also should be reflected in the deck. Like in the early stage, if I don't see like a clear vision how this is going to be a huge opportunity, then it becomes a huge problem in the future, right? And then the second thing, like on the growth stage now, if I don't see like already good traction and good metrics to support your story, then it becomes even more questionable.
Okay.
Right. But I think one thing I usually see a lot is I see a lot of surface level thinking from startups. It's like, hey, SMEs don't have funding, so I'm going to give them funding.
Yeah.
But why don't they have funding? Because banks are here and banks have all the information. All the information and all the money to give to these SMEs, but they're not giving them, right? Because it's too risky.
Yeah.
Right. And there are also factors around that. So I really want to see a deep understanding of the space you're in. And I think that's something that most of the time I don't see. Because a lot of ideas I see is like, hey, these people have money here. Someone else doesn't have money here, so I'm going to connect them. But there's a reason why these people are not being connected, because the risk is too high. There's also other opportunities for banks that they are comfortable with. Regulation sometimes does not allow. So there are a lot of factors in place. But the ideas I see are most of the time very surface level.
Okay. Okay, so Flo, we are now at a stage where investors have put pre-seed, seed. We're in a pre-series A. And that means we have some equity investors in the business. So then how do you maintain a healthy cap table? And how do you handle dilution as a founder?
Yeah. Okay. On the point of dilution, I would say it's better to own 1% of $1 trillion company than 100% of a lower company valuation. So I would say as you grow, it's true. It's very important to think about how much dilution that happens across the journey. But it's also very much needed because you really need to raise this capital. I try to encourage entrepreneurs to sell 10 to 15% at each stage, right? From a pre-seed, 10 to 15%, seed, the same. And then that will take you to a healthy space once at the time of exit or the time of hopefully of an IPO, and hopefully we see more IPOs in Africa, right? So think about those dynamics and how much are diluted. Obviously, as you grow, you don't need to be as diluted because, again, it's about de-risking. So the risk has kind of reduced compared to earlier stage. So you can maybe, as you go past Series A, you can maybe think through how much lower the dilution should be. Right, so that's on the dilution. The second point about maintaining
a healthy cap
momentum. Cap table. Yeah, I think maintaining a healthy cap table is it's good to have diverse group of investors.
Yeah.
Right. But most of the time, startups don't have that luxury.
Yeah.
You pitch to someone, do your best. Like, I'm very excited about this opportunity. I know you're raising 1 million, but I can only give you 50K.
Yeah.
Right. So, okay, fine. So now I go to the next person and you pitch. So sometimes just a necessary evil you have to go through. But as you as you grow through different stages, one is very important to think about the rights of each investors. Right? Not all of them have to be on your board. Not all of them have to be, private kind of information that significant owners will have. So raising through like syndicates, if you have like a syndicate of investors, putting them in syndicates and like, you know what, I'll give this update to this syndicate. And if you have any question, you can go through the syndicate. That makes it easier to manage. Right. But yeah, most of the time it's just a difficult step to go through. Right. So that's on the. We had asked another question.
I have the cap table, and so what you're saying is that sometimes the quality of investors you have on the cap table would determine whether you get more funding.
Yeah, I think as investors, we like to pump ourselves and tell us, we give you a strong value addition. We help in so many ways.
Yeah.
And it's true. Some people help, and it's very helpful for the startups, but it's usually around the capital. It's really interesting to when you're building your cap table to think through who can actually help me across the journey.
Okay.
Not just at this stage, but as I raise through higher amounts, who can really help me to unlock more capital. That's one. You can also think through like, hey, who can maybe make strategic introductions, or someone who has like portfolio companies that we can work with together, right? But capital should be point number one. Is this someone who can actually support me across different funding rounds? Right?
So it is important what other service or what other impact an investor can have on the business aside from capital.
You can, you have to think through that, but capital is number one of those.
True.
I will tell that to an entrepreneur. I will write to them. That's another point.
Okay. And so, Flo, as we close this discussion, we know that fundraising is not easy. It's a tough journey. Very tough on founders. And so then, as founders wait for the magical moment where they get a solid yes, how can they maintain momentum?
I think maintaining momentum is one of the most important things, right? But I think what you need to really show is strong execution capabilities. Everyone has great ideas.
Yeah, true.
Every single day.
All dreamers,
Yes. All of us are like, yes, I wish I could start this company. I wish I could do this. But it's all around execution. You might have not the most attractive idea, but the execution is always very key, right? So if you don't have a regular update to key stakeholders, not just investors, but everyone who's involved in the process, key customers and everyone, you should have one as an entrepreneur. Every month, just send them an update. It's like, hey, this is what we did. We grow by this by this percentage. This is the new customers we get. This is what we need. This is where we're going the next month. Okay, next month, this is what we said we were going to do. We did it, right? Now we are thinking of doing this, right? And this is how we're going to be like in the following month, right? And you can help us this way. Also encourage them. Like we're looking for capital, we're looking for talent, looking for strategic introduction to potential customers. You can help us this way. And then that way you can, every single month you show like, hey, I'm knocking out things on the list. Whatever I say I'm going to do, I will do it. If you haven't done it, it's fine. But just say this is the reason why we didn't do it. And this is why, this is how we're going to address it, right?
Okay.
So showing that you have strong execution capabilities is very much important. Another thing that I rarely see, almost never see, is an emphasis on the team. You might be the greatest founder, but you can never build a great business on your own. You need a strong team. So you really need to show how strong your team is and how you can actually convince them to stay with you and work with you. Most of the time, what's going to happen is if I'm a 10x engineer, I will get offers from Google, I'll get offers from Microsoft and all the big companies. So now here you are as a startup, you're telling me I'm going to pay me 10% of what I'm supposed to get at Google or Microsoft, right? And I'm going to have way more work, more pressure. To help you set up your business, right? So you really need to show that, hey, I can attract great talent, and not only that, I can also maintain that great talent, right? And I think if there is a way you can show it, like, hey, we just poach this entrepreneur from Google. You know, most of the time it's through like, you know, equity, give them ownership in the business. Because you are telling them, you know, true, it's hard and it's not as high paying right now compared to the future. But if you hold this equity for the next X number of years, the returns you're going to get, one is going to be way higher than anything you could have gotten anywhere else. And significantly, and more importantly, it's around the impact. Kind of so you need to be selling the vision to the talent. If you manage to get a great team, I think you're halfway there. You're really halfway there. You're halfway there through fundraising. You're halfway there building a great product. You know, you're halfway there building a great company.
Okay.
All right. So team is always at the top of my mind.
Okay. Wonderful, Flo. Thank you so much for your insights today. And I believe founders have had the story from an investor and someone who has been in the VC space for quite a while. And I'm hoping they have learned something that they can take on and apply or use in their fundraising journey if they're already on that path. Yeah,
thanks for having me too. Really had great fun. So hopefully we're helpful in some way.
Yeah. Thank you so much, Flo.
Thanks, Linda.
Bye.
Bye.